Grid, I just wanted, because there's a lot of new faces. Grid launched in Charlotte in May of this year. Grid as a national group launched in 2007 in Reston, Virginia. And so there's a national group, and it's a great platform for education. And so we just plug and play into the different topics that they come up with, and we present subject matter experts to the group. The great news is you saw 42 people, obviously 42 people are not here, and it varies, different subject matters. But there's 190 members in the whole Charlotte group. And so we try to go where the people are. And so sometimes we are in other Charlotte areas. We've been in Fort Mill a few times. It's just convenient for you. So we stayed in Fort Mill. But we try to spread the love around Charlotte. So the next one will likely be at a brewery, because we're going to be doing a State of the Union type of moment where we're going to talk about best practices, what's working, what didn't work, how we think the economy is going to shift now that the election is over, et cetera, et cetera. So that'll be next month's topic. And I would love to know from the group real quick what's working. If you have like a sweet deal that you'd like to like share with the group, and maybe like 2 shares about something that is like brewing in your world, investment wise.
I'll go first.
Okay, great.
Absolutely nothing is working right now.
Share who you are. And
I'm Steven. I'm originally from Charlotte. I own a duplex in Rock Hill. It's the sole reason I came down to Rock Hill. I did that in 2018, and I've been looking ever since. And I spent most of COVID looking, which was very difficult. I kept getting bought out by cash buyers and stuff like that. So readjusted my strategy and decided to just start putting up some of that money that I was getting from my duplex to use for my next acquisition. So,
great.
But nothing's working. If you guys can get that in me. So, at least for me.
When you say when it's not working, like what are you doing?
Just so I was looking for a small multi-family, like the lady over there. I was looking in Columbia, of course not Charlotte. Well, I wasn't looking in Charlotte, right. Their prices, which is the reason why I'm down in Rock Hill. So I was looking for 2 to 4s, just trying to just get in a place where I could beat out some of these investors that would come to town. I couldn't.
Have you thought about seller financing?
It was rare to come across those deals.
Yeah.
But I have a great agent that was trying to help me, and I just couldn't work it out. Okay. Yeah.
When were you trying to sell it on this strategy?
I think we had, I want to say 2021. I found a duplex down in Columbia. It's right in West Columbia, right off the river. And
you're wrong time though. Yeah. Right, because 2021, right? What was going on? What was going on with real estate values?
Right, they were going up. Right, exactly. So it was
why would someone seller finance? Seller finance today.
Yeah.
Today for the next 2 years, probably, because people are going to need to get out of their properties, and they're not going to be able to sell them for what they want. They want to, like the 12 unit that I said we just offered on today. There's a seller finance component to be offered.
Okay.
It was, I forget the exact, I honestly, my team put a deal under a deal, like put the yellow, I didn't even read the yellow why, like I was showering, come over here, I was going to, they're not buying, otherwise they're not going to do it. But I think it was like 1.9 cash at closing, and then like 2.2 seller finance was the offer that we made. So like we're doing, like now is the time to really like double down on that strategy, because people just can't get what they really want.
Yeah, that makes sense actually.
Yeah.
And have them do a search for like houses that have been, or properties that have been on the market for like 45 days,
Right.
which is so small of amount of time that like sellers literally have this idea in their mind that houses will sell in 3 days.
Right.
And so when it gets to that 45 day mark, they freak.
Right.
So the higher the days on market, of course, the better deals you'll get.
Right.
Thanks for
Yeah,
sharing.
we used to pick up when I was doing fix and flip before I had a team. I had an auto search set up from a like local realtor in Philly, and the search was literally 90 days on the market or more with at least 2 price reductions, and I would just throw retardedly low offers.
Right.
Like I wouldn't even. It was like
I've gotten some of this from you.
Wait, I didn't see it. I didn't do anything like that. I just sent the offer. Like I sent an email to the agent. I want to offer on this one at this price and this one at this. Like they probably didn't even write up the offer. They probably just emailed the agent because of how absurdly low it was.
Yeah.
I wasn't even trying to get them to say yes. I just wanted to see if they countered.
Right.
And then if they countered, it was like a game on.
Right.
So my 50% advance offer got a response. They're motivated.
Right.
And there's a lot of people that say yes if you're writing enough offers.
Mm-hmm.
The hand raisers,
It's a volume.
nuts.
It's a total. I was so like, yeah, it's funny because you hear it when you're first like, it's a volume game, it's a volume game, it's a volume game. You're like, yeah, it's a volume game. I'll make my 10 offers, I'll be fine. Not even close to the volume that needs to be reached, right? It's like, imagine the volume that you have in your head and then like 10x, right? If you've ever read Training Card 10x, so literally 10x, whatever the figure is in your head, and you might be it.
Okay.
So I just had a change in my team. I had a business partner for a couple of years. We split off earlier this year. And so I have a newer acquisitions person. My old business partner used to do acquisitions. And my new acquisitions guy is coming from like institutional land, right? He's like Wall Street hedge fund and like serious groups that he was working with. He was trying to go out on his own and he didn't have any experience, and nobody was taking him seriously. So we teamed up together, and today we were talking, dude, I don't know what's going on. Like, we looked at like 130 deals and we haven't gotten one yet. And I was like, well, okay, well, first of all, that's not true. Because we had been awarded a deal in Orlando. It looks like it's on life support right now, and it's not looking pretty. And then we just got a deal accepted, an LOI accepted. We found it on Crexy.
Okay.
It was up forever. It's distressed as shit, which I love right now. So we found that deal. We just got that accepted, and then it sounds like we've got a good chance of getting this one, 12 unit here accepted. So I was like, I hear what you're saying because nothing's closed yet, but we got awarded one over here that we're going to walk away from. We're like got these 2 right now. I was like, but dude, you've got to realize that you're not in fucking Wall Street anymore. You don't have the cachet of the hedge fund behind you anymore. Like, welcome to my world, bro. This has been my life for the past 5 years, right? So you just feel like keep that in mind.
Okay. Yeah. Makes a lot of sense.
Thanks for sharing.
Yeah.
All right, since we spent time on that, let's start with you. So Adam, who are you? What do you do?
So I'm Adam Balsinger. I've been a full-time real estate investor for going on 9 years now. Started out doing single-family fix and flips. I did wholesaling. I built a small rental portfolio up to like 18 doors a couple of years back. And really a lot of those were lessons in terms of like what I liked doing and what I didn't really like doing. And I learned a ton as a business owner and grew a lot as a business owner over that time. But what all those experiences really kind of did was shine a light more on where like the direction that I wanted to go and how I wanted to build a business and live my life, right? And so I think a lot of times we get started and we think the idea of being self-employed sounds really cool. And then we become self-employed and it's a fucking prison. It's literally a fucking prison. It was for me, at least that's what it felt like. I'll apologies. I swear I'm not politically correct. I probably should have started with that. But so the fixing and flipping was a headache to me because I hated dealing with contractors, right? Like I am somebody that when I say something, I'm going to do my absolute best to do what I say I'm going to do. And contractors typically do not operate on that same character level, right? At least the ones that are happy to work with real estate investors, right? You're dealing with literally the bottom of the barrel contractor in most instances because the good ones charge more and they get hired by homeowners, right? That are willing to pay more. So that was a 3-year of just like, struggling to do deals. And, we were doing 4, 5, 6 deals a year or something like that.
When you started investing?
Like almost 9 years ago.
So where?
Oh, Philadelphia. Yeah, it's where I'm from. So did that, and then I discovered this wholesaling thing. Oh my God, I can like flip properties and I don't have to deal with contractors that pay my existence. This is perfect, right? And not realizing that now, instead of running a marketing construction business, right, which is essentially what you're doing as a fix and flipper, now as a wholesaler, you're running a marketing and sales organization. That's what it is. It's just real estate is the product, right? And so I traded contractor issues for seller issues and title issues. And I was like, oh my God, I don't know if this is any better. I get paid faster. Like I don't have to raise money. So I guess it's a little like, but whatever. It still wasn't really what I wanted to do. But I was doing those things. Thought process back then is okay. I'll do this. I'll make a little money. I'll stack cash. I'll go buy rentals. So I was buying rentals, and like I said, I built up 18 doors, and some I owned outright for straight cash, and the majority of them had debt on them. And I'll tell you, like burring sounds really cool until you want to live off of your burr properties, and then you're like, this sucks. What the hell am I doing? $100 a door across like 18 properties. And then you're like, oh, well, I have 2 vacancies and I actually now have to replace this fucking water heater that blew. And so now the money that you made throughout the course of the year, by the time you like put your tax return together, you're like, how did I lose? I lost $1,500 last year on this board. Like, what? How did that happen? Meanwhile, it's not as easy to run a property manager as you think, right? Like, it's not really passive income because you have to like hold your property manager's feet to the fire. Like they have to know that you exist in order for them to care to actually like manage your property for you. And like an idiot, I bought a property. I thought it was a good idea. Like I'm gonna test markets, not do enough research to know which one's better, but I'm gonna buy. And so I had 18 doors in like 5 markets. What was I thinking? So I had 5 property managers that I was dealing with, 5 sets of like, it was just not good. I still loved real estate. I knew some people, I'd met some people that were like crushing it in real estate by this point, and not all of them were that sharp. Like I've always been if that person can do it, I can figure this out. I don't know how long it's going to take, but I didn't need to win. But so it just became like, how do I do this business? 1Z, 2Z is great for some people. And I think it's a phenomenal retirement plan, right? For people that like love their 9-to-5 job. I think you're better off burning a bunch of properties, buying with your rolling over your 401k. I'd rather have my money in a bunch of rental real estate than I would in like the stock market, and that's for damn sure. So there's different strokes for different folks, right? But so syndication, I spent 50 grand. I went to a guru, syndication guru program, RA Mentor out of Boston. And, a lot of people shit on those programs. Like, I'm here and I own $62 million. I control $62 million worth of real estate. And I don't think I'd be here right now had I not like spent that money. So spent the money, did the program, for 2 years, like banged my head against the wall trying to find a deal. It literally took myself. Initially when we got started, I had 2 other partners. 2 years of the 3 of us kind of banging our heads against the wall looking for our first deal. Finally did our first deal in 2019. So we closed our first deal 2019, September. We bought 92 unit property in Stone Mountain, Georgia, which is about 30 minutes northwest of Atlanta. We bought it for 4.8. We sold it earlier this year for 7.2. Was a projected 5-year hold. We were in and out in less than 2.5 years, and our investors got a 20% return on their cash. I was a little pissed actually because it should have been like 25%, but it took the buyer a while to close on the deal. It took them like 6 months to close. So when you extend it another 6 months, like that can have a significant impact on your average annualized return. But so we sold that one. Fast forward today, we still control 8 deals, 8 assets that we own throughout the Southeast, North Carolina, South Carolina, Georgia, and Florida. 691 doors. And then, as I mentioned, I split with my partner a little bit earlier this year. We kind of had some differences in vision and opinion and what we wanted to do and how we wanted to grow the business. And so, syndication is great. I love it. But at the same time, I'm not a hedge fund. I'm not an institution. We're competing with a lot of those groups. And so it's hard to win deals. And I don't want to be forcing deals across the finish line that don't really hit the parameters that we want, just for to chase the fee that comes in. So when we close a deal, there's an acquisition fee in multifamily. So, you're still not making, I didn't make any real money in syndication until this year. So the first 4 years I made like 40 grand total. 0, obviously years 1 and 2, we no deal. But so, I'm not trying to pour something across the finish line just to collect an acquisition fee. And so thinking about that, it was like, all right, well, I have a lifestyle that I want to be able to live and things that I want to be able to provide my family. So how do we generate additional revenue while still kind of holding true to our fundamentals and the deals that we want? And the conclusion that I came to was we should do more deals. We should expand the buy box. We should continue to do the multifamily syndication, but we can do other kinds of investments where we can, again, we still have the investor database, right? Like, why do we only have to do one thing? So this time last year, we wouldn't even have looked at that 12-unit deal. I wouldn't have looked at the total piece of shit mobile home park that we're about to buy. But that, my other business partner really thought it was important to focus 110% on multifamily. Cool. You go do that, and we'll go do this. So that's where we're at. That's us. So today we are my wholesaling business partner. I'm 50-50 partners with him in a new entity that we just formed, B/Strategies. So we're burning deals up in Philly, like smaller stuff. The first 2 were singles. We don't really want to buy singles. We're trying to buy multis. So we're doing that. The intent there is those will be legacy properties. We're burning them. We're paying off the investor. They're cashed out completely, and it's just us in the bank. So then down here in the Southeast, we're continuing to syndicate multifamily, but we're also looking into mobile home parks. We're looking at smaller deals that we can do as joint ventures instead of a syndication. And then we're also looking at some different asset classes. So I am really, really excited about the concept of buying businesses. I'm an entrepreneur before I'm a real estate investor. I can even talk about real estate for I don't care. 2 black words, I don't care. It's a repeatable business model, right? That's the thing that's cool to me about real estate. You learn how to do one deal, you million. So I'm really, we're looking at some SaaS companies right now. We're looking at some, you guys are probably going to, this sounds ridiculous. So we're looking at SaaS companies and we're looking at contracting businesses. Those are the 2 businesses that we're looking at right now. One of the guys on my team is actually, he's a part owner in a software company already. So he knows a ton about software. cool thing about software is that you don't need a lot of people. People typically need problems that fall in, of course, your lap, right, as the kind of leader of the group. So you have crazy profit margins in software because it's like 2 or 3 people can run pretty decently sized business. Contracting is a total opposite. It's like all people, right? But I think that most contracting businesses are poorly run. I've dealt with a lot of the people that run them. They are like the total E-Myth, Michael Gerber, right? They are the technician that decided that they were going to open up their own business so that they could keep 100% of their revenue, but they're not really business owners. So we're looking at companies that have been open for 10 years or more, preferably have $1 million in revenue annually or more. And with a lot of these are like old school people, right? Like a plumber that's 65 that's trying to retire. His daughter doesn't want a plumbing company. Like, what does she want a plumbing business for? Like, that's a perfect person for us. He's got a couple crews, and he gets all his customers through referrals. Like, perfect. We can come in, we can get this thing pimped out with like all the online presence, and then do more off the business. So that's us. Syndication is really just pulling a bunch of people together to take down an asset that's normally out of reach of the individual. So where, like, those of you guys, how many of you guys do like single family fix and flips or rentals or anything along those lines?
I did one thing.
Okay. She sugar it.
Yeah.
Never again. I never say never, but nothing.
So a lot of times when I'm like trying to explain these concepts, they're a little different for a lot of people. So I try to like draw it back to something that more people are familiar with. And so like fix and flips are a really good comparison to the way that I structure syndication. So when I was doing fix and flip, I had literally nothing. I had a sales business years prior that I shut down. I was like busy chasing girls and partying and stuff, and I spent all my money right out. Fucking perfect. I was literally living in a bedroom with a buddy of mine from college so that I didn't have to live with my parents when I moved home from Chicago. Shut my business down. I partied for like 6 months in Chicago, and I moved home. And I moved to my life. Anyway, so I was getting a hard money loan for 70% of the purchase price, as much of the renovation that they would possibly fund. But I didn't have the skin in the game that they wanted, right? So I went out and I borrowed it. I raised that money from family and friends when I was first getting started because I was like, had just been partying my face off for 6 months and shit. Like, who the fuck is going to lend me? Like, I didn't have 2 6 on there. So totally funded by other people, hard money lender, right? And I refer to this as a gap funder. Anyway, gap funder. So syndication, the debt and a lot of, so like the bulk of the purchase gets funded again by the lender, right? Whoever it is that provides the debt. You could have a bridge lender in multifamily and commercial. Bridge lender is essentially the equivalent of a hard money lender. So if the property isn't stabilized, it's a turd. You're not going to get funded by Fannie Mac or Freddie Mae. You're not going to get funding from some of these bigger groups, right? Because it feels a little too hairy. So bridge lenders will do that. Literally the equivalent of a hard money loan, but the terms were actually pretty good for a while. The terms are fucking terrible. So we get either, typically we've been using agency, Fannie or Freddie, right? Which is a government sponsored entity. They always talk about wanting to put more money into affordable housing. They suck at putting more money into affordable housing because they want a perfectly stabilized property that doesn't have any problems with it. You're like, have you ever, it's a C-class property, like what the hell are we talking, right? Anyway, so Fannie or Freddie agency debt, right? You can find some small local lenders that you can potentially get debt through, some bridge options. We don't typically go out and do all that work, right? We prefer to use a commercial mortgage broker and we prefer somebody that has been around for a little while because those people have real relationships with people within the actual lenders, right? I don't want the brand new, fresh out of college, like filled with piss and vinegar, ready to go tackle the world. Like, I don't want that person as my broker. because you may need somebody that has to pull some strings to get your deal funded and to get you the terms that really work for you. So good luck doing that when you're brand new. So we're like, well, we're not going to try to reinvent the wheel. We'll just leverage this person who has 30-year relationships and then let them do their thing, right? So we get bulk of the funding there. Bulk of the funding is negotiable, up for debate today. We were just looking at the deal that I was talking about in Orlando. The reason that deal is on the ropes right now is we've been under LOI, which means our offer was accepted, for like 2.5 months now, working on the contract. So in commercial real estate, there is no state approved like contract, right? You fill out a letter of intent. Here's my letter of intent to purchase your property. Both parties agree on the letter of intent. Both parties engage their attorneys and they actually write up a formal purchase and sale agreement. We've been working on the purchase and sale agreement for 10 weeks. Unheard of. Literally unheard of. Everybody that I've said this to is like, what are you talking about? That doesn't happen. Usually this is a 2-week process, 1 to 2 weeks done. So we found out later, as we're going through this, the seller has never done a commercial deal before. And so all of this like 40-page contract was totally freaking him out. And his attorney that he decided to hire also had no commercial experience. Why would you even hire that person? What?
Have you even gotten to the due diligence?
No, because due diligence happens after the contract, right?
Yeah.
So
it's just Florida, so I was just wondering if you could get in there.
Well, so actually that was a very common thing that was done. We call it early access.
Yeah.
So last year you had to put down a hard EMD, right? Which means non-refundable day 1 at PSA signature. Okay. That's risky, right? We haven't even seen the deal yet. Well, so what everybody started to do was they would put in hard money day 1 at PSA, but we want early access. So then while the attorneys are going back and forth negotiating the PSA, offer's been accepted, so we feel good. So we're then out on site. We're doing our due diligence before the PSA gets signed. That way, if we see something, we never even sign the contract, we don't have to do REMD.
Yeah.
We tried to do that with this. The seller was really insistent on some hard money. And I was like, no, have you seen the market? Yeah. And they came back and said, well, listen, if you do hard money, the deal is yours. If you don't, it's not. And I said, all right, I'll do hard money, but I want early access. And then we went into this big weird thing with all these weird dates because the seller didn't like early access. It was ridiculous. Anyway, where the hell were I going with that? See, I told you guys this earlier this happened. I'm like mid-thought, going somewhere.
You were talking about Florida and the deal, but I have a question.
Shoot.
So outside of syndication, you run this massive, you control the massive $1 million property entity. Are you taking money from those funds or the equity of those funds and then buying the other asset classes or business? Is it all coming from that, where you have the other entity LLCs set up? I guess my question is, how are you funding all the extra stuff? Yeah, so we're going to syndicate each thing individually. Okay. Is the plan right now. We're weighing the options of starting a fund. Yeah. The challenge with the fund is that we have a couple different asset classes that we're pursuing. And so we would need, there's 2 ways to handle it. We would have a fund for just an alternative asset fund, which becomes very broad. It can be very complicated to put those legal docs together. The private placement memorandums would be really cumbersome. Yeah. Or we could do individual multifamily funds, mobile home park funds, small business funds. I think that makes more sense in the grand scheme of things. It's going to cost triple, right? Yeah.
the positive in doing it that way is I think it's going to be easier to sell to investors, right? The small business fund versus the we're just going to buy fucking anything that isn't on Wall Street funds, which is basically what an alternative asset fund is.
Yeah.
So I think we would get buy-in a lot quicker and a lot easier. I think it'd be easier to raise capital. The timing I struggle with, right? Because typically when we start a fund, it's open for a while.
Right.
So what we're going to open 3 funds at the same time and have 3 competing funds that we're essentially like cannibalizing ourselves with our own investor. We closed 4 deals earlier this year and they were like in 3 months, boom. And we really struggled with the capital. We almost dropped the 1 deal because we'd never raised for that many deals before at the same time. And it was a real stretch.
Is there an opportunity for a lead magnet, like a lead funnel? So I look at it like, of course, you're going to acquire different interests if you go the 3 different routes. And then you can, I don't know, whatever your marketing strategy is, literally just capitalize on the fact that I would love to invest in a mobile home park, but I don't give a crap about a business. Right. And so like you could potentially get 1,000 different people to
it's so that's a really good point, and it might be doable. The SEC has rules set up of who you can raise from and who you can't.
Right.
So the only challenge there, like I think it's really important, and like one of my core values and my core beliefs is that the government should be out of our fucking lives as much as humanly possible. So the fact that the SEC tells people what options and what investment opportunities they have that they can invest in and can't, I think is total bullshit.
Yeah.
So I don't really ever see us running a lot of 506C because I don't think it's right. I think that everybody should have access to the same kind of investment opportunities. And so I don't know what the legality would be with advertising for the fund the way that you're talking about.
Got it.
The only way we may have to do it as a C in order to, or accepting only accredited investors to be able to do it.
Right.
Do you think that the path that you took to get where you are was necessary so you could kind of eliminate?
Absolutely not.
So do you think that someone like myself, who's a real estate agent right now, not by default, kind of by default, not really by intention, I really got my real estate license so that we could eventually be investors ourselves and build that kind of like a rental portfolio, not really interested in fixing flips. So do you think that someone could build a rental portfolio and then eventually move up to commercial where you're buying apartment complexes and things like that? Or do you think that there's some steps in between that you would need experience for? No? Okay.
No, because so the experience is different. Your experience as a single family rental owner is different than your experience as a multifamily, right? Totally. You should, in my opinion, and this is gospel according to Adam. Again, I don't want to do stuff, right? I'm trying to delegate like everything. So I would never want to manage my own properties, ever. So I'm hiring a property manager for the single family house. I'm hiring a property manager for the 150-unit apartment complex. The difference between the two is that you don't have to babysit the one that you hire for the 150-unit apartment complex to the same degree that you have to babysit the other one. So you're getting experience in real estate. My overall opinion on this is that wherever you feel most comfortable right now, that's where you should be. So there's this whole thing in multifamily syndication, go bigger, go bigger, go bigger. That sounds cool until you go so big that it scares you and you wind up not taking action because of fear, right? Like we're really weird when you factor in like all the weird mind tricks that we play on ourselves and the way that we like justify things to ourselves and lie to ourselves to the point that we convince ourselves of the lie. Like the brain is really interesting if you think about it. So if somebody's most comfortable pursuing single families and building a portfolio up to a certain point and then leveling up, I think that's what they should do. There's like this balance between pushing yourself in a healthy way versus pushing yourself in a way that prevents you from even taking action. So I don't know that that really answers the question, but that would be my perspective. You know, you'll probably have an easier time raising capital for your single family than you will for your multi-million-dollar apartment complex. But here's what people screw up all the time with syndication. You don't have to be the person that provides all the different things in order for the deal to happen. So we raised very little money on the very first deal that we ever did. We didn't even find the deal, the first deal. I made, you need something called so in commercial real estate, being approved for a loan is a little different than a resi loan, right? So resi loan is like income, expenses, credit score, right? They don't give a shit about your credit score if you're buying like multi-million-dollar apartment complexes. What they're looking for is net worth to be equal to the loan amount. They want you liquid. They want you to be able to cover typically 9, 12 months of the mortgage. They would just want that cash like sitting in an account somewhere. And then they want experience owning a similar asset. So I didn't have any of those things, none, right? So I needed to find that person. One of the best things that they did at RM Mentor, which was the guru program that I took, was they had a sponsorship event, they called it. So loan guarantors, sponsors, key principal, it's all the same thing. It's just one of those like different people call it this versus other people call it that kind of thing, right? So they had this sponsorship event. It was like speed dating for sponsors. And I met like 2 or 3 people that weekend that I hit it off with. And I actually left the event early to take a cab to the airport with one of the guys that I had met. It's like, oh yeah, I'm leaving. I was like, oh no shit, oh your flight leaving. Like, oh yeah, mine leaves like really soon too. It was like 4 hours later. I was tagging along, right? So like we got to hang out, shit. We spent like an extra hour and a half together, which I think really probably helped. We threw a bunch of deals in front of him as our sponsor for several months, and just nothing was hitting. And he called us up one day and was like, oh, I saw this 92-unit deal. I'm not buying under 100 units anymore. Steve, it's 8 units. Like, are you sure? It's like, I don't like, you guys can take a look at it if you want it. I'll sponsor it. And, that can be your first deal. And we're like, okay. So he sponsored it. He found it. He helped with the equity. He brought in another person that helped with the equity. We raised very little equity. And his property management team ran the deal. So like to say that we had very little to do with that deal would not be a stretch, but it made us real. And that was one of the reasons that we were having trouble before, is because we didn't own it. And so now we were a general partner on this deal. We started talking about that. We started to lead with that when we were talking to brokers, because when you don't have any experience, we're like, don't ask. Please don't ask, right? If you're not going to lie, that is. So, that was a barrier for us, was just being taken seriously initially. So, but yeah, no, I think you start wherever you start.
So when I read the description for this tonight, just to, how to be able to buy multifamily and stuff like that, other than like the passive income that you have coming from a rental, which isn't much in a good setting. Most of the time need a down payment. So unless you
or a great investor partner.
Just that's what would you say is that the best way to
we have an investor of ours that is our go-to for what we refer to in the multifamily syndication space as at-risk capital. So that's your earnest money deposit. Earnest money deposit at a minimum is typically 50 grand. I've referred to this mobile home park multiple times. So 1.8 million purchase. It's 158 packs, but it's 30% occupied. The best. So it's going to be a $30,000 earnest money deposit. So what we were doing prior to us having any money, we had an investor and he would give us an unsecured loan for whatever it was that we needed for at-risk capital. We were paying him 20% annualized. So, you know, theoretically, we should have been holding his money for anywhere from 2 to 4 months on average, because it was usually 30 days to for due diligence, 30 days to close the deal. But so we were getting 20% on his cash, and it was totally unsecured. I signed a promissory note, personal guarantee, every time, right? Because it's literally like that money. If something goes belly up and we walk away, you know, we could be out several $1,000s and happen to it. So, you know, when you're going into these deals, just understand that yes, you can do it with no money of your own, but somebody's money is going to be at risk. You're talking $5,000 to $15,000 for the attorney that's going to write up the purchase and sale agreement. You're talking probably $12,500 to $20,000 for the SEC attorney to draft up the PPM and the operating agreement and all the other crap. You're looking at $20,000 to $40,000 for the finance deposit.
No, that's for syndication. If you're going to syndication before.
Oh, never mind. Just forget everything I just said. But you do still need an investor, right? So the investor.
Eric, who introduced me to you and who spoke last time, if you go on the YouTube for Grid, you'll see what he chatted about. But Eric would be a private lender.
I think he knows to our Wednesday group.
Awesome. So
Eric,
so he would be a great person to connect with, because that could be a solution from a private money standpoint.
Okay.
For smaller. Well, he could do large too.
Yeah, and if you know Ed and Michael, right?
Yeah.
Charlotte Buyers, CLP buyers, they could have some other hard money lender options for you that could potentially put that money on.
But the big thing, like for you, and not to switch gears, everyone can take this information, but for you, I would literally hop on tax records and start writing letters. I would hop on tax, and I mean, it works for single family, but it works for everything that we do in our business. You'll find the hand raisers.
Do you know who Uncle Carl is?
I met him once at one of the meetings. Yeah. He only came once.
So that's how he operates his entire business. It's the GIS and tax record. And typically he does a lot of land, and he trained this guy, Brandon Maxwell, who now is out on his own. And Brandon has found a couple like really good pieces of ground that he's now partnering up with some other guys locally that I know, Hamal and Yomesh, with a company named Exponential Equity, and they're doing like 2 or 3 big developments together. And Brandon literally like is a GIS tax record where he finds everything. It's total sniper approach, which was the complete opposite from the way that we ran our wholesaling business, which was fire hose. Open up your mouth and turn on the fire hose. That's how we ran.
We have 2 land acquisition deals that we just went on. The auction for York County was 2 weeks ago.
Yeah, it was.
And so we targeted, that's the wrong word. We wrote letters to everybody on the up for auction list and asked if we could help them with their lien before it went to auction. And we're wholesaling everybody who said yes.
And some of them did.
Yeah. So, I mean, that's one strategy too. Just there's a whole bunch of multifamily on there too. There's a whole bunch of it. You just have to get creative. And like, sounds like you're hungry, but
yeah, the stuff I see, I'm on an auto search that's like all over the area, and everything that I see that's multi is I would buy. It's all too much. Like the asking prices are off. Yeah, no, I'm saying they're not deals.
Like yeah,
they're too expensive. They're asking for too much. The returns aren't there. So you're probably still better off looking.
And here's another thing that I just learned because I made an offer on a frat house down in Winthrop, a former frat house. So I asked for a long due diligence period because I knew Rock Hill had the short-term restrictions. Well, found out that you can't have more than 5 non-family members living in one house at all. And the only reason why the fraternities get away with it is because they are fraternities and sororities. Well, if you wanted to flip that frat house into college housing, you can't. Right. So stay away from college housing in our great county. Alex, and now she's breaking out. Yeah.
Well, you could, but you couldn't have more than 5.
Yeah, but it was a 9-bedroom, or it housed 9, in order to make any money, you had to have 9 rents.
Yeah.
She screwed herself. But I had a long due diligence period, so.
It's a ridiculous rule. They had that at Penn State when I went there.
Okay.
So nobody followed the rule. What everybody did was when the inspector came out, you obviously knew, right, when the inspector was going to come out, you just move all your shit out.
Well, yeah. I mean, as the landlord, I would hope that would happen, but I don't think the college students would appreciate that.
Probably not.
But yeah, that
would
be
work for us because, we got the pledges to move.
Fair. But yeah, that was a $375,000 house that can be rezoned, huge parking lot. Like that was a deal to be had.
That was in Rockview?
It was
just the parking lot sold.
It was the Pike House.
Yeah. On Charlotte? Was that on Charlotte?
Oh, gosh, I couldn't tell you now. Park Road, essentially. I think. Yeah. But that's why you underwrite deals.
The fraternity sorority rules are weird. In Pennsylvania, you can't have a sorority house.
It's a brothel. Yeah.
They consider it a brothel.
Yeah.
It's unsupervised. If there's too many women that aren't related, there's no supervision, it's considered a brothel.
That's wild.
So at Penn State, the sororities will take over the entire top 2 floors of the dorm building. So the girls live in the dorm for freshman, sophomore, and junior year.
Wow.
So yeah, don't just fire and execute. Make sure you underwrite anything. That's why I'm saying about the Florida thing. I would check that thing out.
Yeah, but we're not even going to get to that point. Yeah. It's just such a mess. We actually found some. So we don't even want that deal anymore. Interest rates are going up so quickly and so aggressively. And when we wrote that deal, we underwrote it at 5.5%, 6% interest rate, something like that. And they're just not there.
No, they're at 9.
The rates have gone up so significantly that we're that's why we went back to a retrade after we finally, 2 weeks ago, we finally got the friggin' language taken care of. And we were like, okay, cool. So now we've got that taken care of. We can't buy it at this price. And we had conversations internally do we want to drop that bomb on them now before we get the language straightened out? Or technically, if we have more leverage, if it drags out longer, they're more likely to renegotiate. So we went back. It's called a retrade when you go to change price, change terms. And they were like, no, but the owner has a real estate lending business and they'll give you the debt. And we were like, well, what are the terms? We'll give you this $5.5 million at 5%. And we were like, sold. Yes. We're trying to actually unload the deal. You really, it's very difficult to wholesale large multifamily, but we're essentially giving the deal to somebody else and they're giving us a hit. So I'm still in worry about it, but it makes me whole from the attorney fees and everything else that we spent. But it looks like that can fall apart now. So there were a couple things that were concerning about that deal. Florida, Orange County, which is where Orlando is, has on the ballot yesterday, they had a rent control, a year, 12-month term rent control that was on the ballot yesterday in Florida, of all places.
Did it pass? You know?
I don't know. Yeah. I've been paying less attention because I'm mentally over that deal now. But that was a big concern for us because we were looking at like $150, $200 rent bump with very little work. It's just rents skyrocketed so much over the past few years that you could get away with buying a deal, putting almost no money into the units, increasing the rent. You could increase from 100, 100, 200 bucks like with every turn. And then you were out of the deal in 2 years. It was easy.
Yeah.
But so now with interest rates going up, what's going to happen is cap rates have compressed pretty extremely over the past couple of years. Like, you know, you could be buying a C-class property, you would have been buying like a 6 to 8 cap a couple of years ago, where like I saw something that sold at a 4.5 cap that was a C property lately. So these cap rates.
Why would they even do that?
Because you're still making money.
Yes.
Well, today I have no idea why.
Yeah.
They're idiots, I think, is actually the answer to that question. Well, everybody has a different perspective on what's going to happen, right? I mean, there's so many variables at play when you're talking about, well, what's going to happen to the economy and how this is going to get bad. It's going to get really bad. It's going to be a soft land, right? Like, and there's no consensus anywhere. It's scary when there's a consensus because half of the people telling you this stuff, I think, are fucking retards in the first place. Nobody knows, right? Everybody's guessing, but so it's complete opposite end of the spectrum today. But so our thought is, okay, well, let's prepare for the worst. So what I think is going to happen if the Fed continues to increase rates, which they've said they're going to do, they also said they weren't going to do a 75 basis point rate hike like 4 months ago. And then the very next Fed meeting, they did a 75 basis point rate hike. So Jerome Powell's words don't really carry a lot of weight, you know, like they just tell you whatever they think they need to tell you at that given moment in time and change the story later. But so I think that they will likely need to continue to increase interest rates. Otherwise, they just have to let inflation go out of control. I don't think they're willing to do that. So I think that they're going to throw water on the economy right now, short-term pain for long-term gain. And if they continue to increase interest rates, then there's no other thing that can happen in my mind other than cap rates increase. And so cap rate calculation, there's only 2 variables to determine the cap rate. It's the net operating income and the asking price. So and the asking price and the cap rate are inverted, right? They don't go the same way. So if your cap rate goes up, your value comes down, regardless of if the net operating income stays the same, right? So you can buy a deal, you can implement a really great value add strategy, you can execute the strategy really well, you can actually cash flow while you own the deal, but if you bought it at a 5 and you're trying to sell it at a 7, the deal is fucked. Like, it's not going to make any money. You may actually take a loss just to get rid of this. So our approach right now is interest rate agnostic is the term that we're calling it in with my team. And really, it's like no brainer. Like there's no way that this deal loses. Like this Aiken deal. That's what it is. It's in Aiken. The thriving metropolis of Aiken, South Carolina. It's a phenomenal mobile home market. It's 158 pads. We're buying it for $11,400 a pad. How do you lose on that? Assuming that we're able to execute our business plan, right? How do you lose on that? 160 pads almost for less than $2 million.
The land.
Yep. We have the stabilized value at 7 or 8 million. We're buying it for less than 2.
And your intention is to buy and hold.
The intent with this, the other thing I love about these really hairy deals is it makes refinancing and paying our investors off a more realistic endeavor. So like, if you're doing a bird deal, right, on a single family property, can you buy a pretty property? Why not? You can't add enough value to it, right? You have to sell it at 100% of its market value in order for you to get your money back that your investors off, right? So if I am buying things that aren't really distressed, which I said the past couple of years, we were buying things that weren't really distressed, we were just increasing rents, that's it. We're not really doing much to really add value other than just riding inflation.
Sure.
Literally, like we've seen over the past 2 to 3 years, historic average annualized rent increases. Did you know that the average rent increase year over year from middle of 2021 to middle of 2022 for 2-bedroom units was over 20%? Nationally, 20%. You imagine that? $1,000 next year, $1,200. Like, what the fuck? How did that happen? So it's not realistic that that's going to happen anymore. Rents can't continue to go at that pace, especially with the price of everything else going up. So eventually people run out of paycheck. So rents can't go higher anymore. So if you can't lean on just easy rent increases and cap rates are decreasing, the only way to get into a good deal is you buy the total shell that needs the full gut renovation, because you can buy it for 15 cents, 30 cents on the dollar. You renovate that sucker. Even then, you're all in at 60% of ARV, right? So if I can do the exact same thing with just a much bigger asset, and I can do the exact same thing.
Would
right?
it
You can rebuy, keep the whole thing.
Would it be a better ROI if you seller finance every single one out
We are
after you flipped it? I mean,
so. Yes, you're going to get more income, more cash flow if you do like lease options or seller finance on the individual mobile homes themselves. But now you've also totally changed the deal. So now we are managing all of the tenants, and now like we don't want to do that. So our strategy is just a straight sale of each home, but it's going to depend on the creditworthiness of buyer.
Right.
A lot of your buyers that buy mobile homes are not necessarily like, they don't have 800 credit score.
Right.
The vast majority of them. So there's a very good chance you wind up owner financing or lease optioning several of them.
Yeah.
This is actually it's like 8 or 9 parks that are all like almost right next to each other. So what we're talking about doing, we're going to buy the whole thing. We're going to turn around the largest of the parks. The largest of the parks is like 20, 30 units, something like that. We'll turn that one around first. We'll sell that one. Keep the other 7 or 8, pay down as much of the principal as we possibly can in the sale of the first one. That'll help the returns for everybody. But then, you know, it lowers the basis. So like I said, it increases the returns. But then it will give us additional cash that we can then go and use and buy more homes, sell more homes faster. But the intent is to cash out the investors and hold the deal long term. Which I've been wanting to do for 5 years.
Yeah.
Because when we, you know, you're doing this, you're like, all right, cool, this is great, but it's still active. I'm still selling the deal. It's just rather than selling it in 3 to 9 months, I'm selling it in 3 to 7 years. So it still is kind of like, when people talk about syndication as if it's like this buy and hold. It's not a buy and hold strategy. It's still a flip strategy, really, unless you know, all depends on the exit.
Mm-hmm. Yeah, I look at everything not as syndication, so that was a good explanation.
Mm-hmm.
I'm writing offers for mobile home parks.
Oh, are you?
Currently, yeah.
Yeah, this is gonna be our first one. It's gonna be a train wreck. Can't wait.
Yeah, our strategy, because again, we're not syndicating, so our strategy is going to be to flip whichever ones don't have tenants in them. Obviously, the tenants one will keep in lease situation, but we'll flip the vacant ones and then seller finance those deals so that they're not going to pay, right?
Mm-hmm.
Like we know that they're probably not going to make out. So then they come back, right?
Mm-hmm.
And that's sad. And it's a business. And they can live there paying rent still, but it's not theirs anymore because that's why we had to do the seller financing deal. But yeah, we're looking at one right now that's way overpriced. And just like this, so I bought this building in September of last year. I made 2 years of offers on this property. And he didn't want to take my offer. And then finally, 2 years later, he had to take my offer because he had no other option, right? So, yeah, I'm in it for the long haul with these mobile home parks.
A lot of it's about time too. So this thing has been up on it was up on Crexy for a while. So like, I still like, you'll hear people say, oh, look, that in Crexy is a waste of time. Like, that's where deals go to die. Well, hey, I'm buying one off Crexy right now. I know there's two guys, Jennings and Yaden are their names. They run a Facebook group called My First Million in Multifamily. And they do some syndication, but they do some creative stuff on smaller deals too. I'm saying smaller deals, like 20 unit, 40 unit, right? Frame of reference. But so hearing that from them was what got me thinking like, oh, well, shit, I used to buy fix and flips off the MLS and everybody told me that was where deals went to die. So I'll just look for the like really hairy, like you look at the price and you're like, oh my God, that's a screaming hot price. What's wrong with this place? Like those are the ones that now I'll go one weeknight and Crexy once or twice a week and just browse, wait for something to jump out at me. And if it jumps out at me, it's like, all right, well, how fucked up is this? And can we fix whatever it is that's jacked up about it? So I already toured the mobile home park. We're going to be out there next week. They're all dirt roads. They have a tractor at the office because the roads flood when it rains. So they have to literally have one of their maintenance people get in the tractor and clear off the road so that people don't get stuck going in and out of their home. Going in and out of their home. Why do we think the property is at 40% occupancy? Well, maybe that's one of the big reasons, right? Especially when we do a survey and all the other parks are at like 90+% occupied, and this one can't keep anybody there. It's like some of the things are so obvious. It's like painful when you really are looking. But that guy, he's owned it for 15 years. He's put no money into it. He's effectively run the thing completely into the ground. He is dead on it at 1.5. That's coming due, which is why he needs to sell. He has two other investors that he brought in, each at 150 a pop. So we had tried to make a creative finance offer, and they were like, well, that won't work. They countered and then came back later and were like, sorry, we can't do it because his private investors didn't want, they wanted to be cashed out, right? And we hadn't written up that way. So he's making like literally $0 on the sale of the property. He's making his investors whole and he's paying off his debt and working it up. One of our smoothest deals that we own right now is a 48 unit in Sumter, South Carolina. It's thriving in Southwest. I thought that's where Fort Sumter was. I'm from the Northeast. It's not. I couldn't believe it. I was like, I knew it was a military. I knew there was a military installation of some sort in Sumter. And I was like, it's Fort Sumter, obviously. No, it's Shaw Air Force Base. Fort Sumter's nowhere in here. Anyway, we go there, tour the property, and property is a nice property. As we're driving out there, we're driving like if you haven't ever driven to Sumter, like you drive through like an hour of nothing, no cell phone reception. I have my partner in the car with me. I'm like, is he taking me out in the middle of nowhere to murder me and leave my fucking body because nobody will have no cell reception, right? Well, where did that even happen? So we're driving there and I'm mad. Like this place isn't occupied because it's in the middle of nowhere. And like, why are we even going to this property, right? It was like 80% occupied. We get there, it's 2 blocks from the Sumter Mall, which it's not like Neiman Marcus is at the Sumter Mall, right? Like it's Sumter Mall. But you know, I could hit McDonald's with a baseball from the parking lot, like great strip of like everything, gas stations, the fast food places, Starbucks is 4 minutes down the road, right? It's an 80s build property. They're all 2-bedroom, 2-bath units. The property's in nice condition. You pull in, it's got nice brick pavers, like as the entryway into the actual property. Each unit has its own garage. We're like, why is this place 80% occupied? We're walking around with the owner and the property manager, and I asked, how are you managing vacancies here? Or how are you advertising vacancies? The print newspaper was how they were advertising vacant units. And I was like the penny saver? Like, what? We did no work there other than just basic unit turns and marketed the property like somebody that knew about the internet, and we're 100% occupied. Smoothest property, almost no problems there. Somebody was shot there or something. But so like looking for those kind of problems, right? And what is the problem that can be fixed?
Well, there we go. Thanks for.
I've noticed people sort of look at the clock.
Yeah, I got it. Yeah. Well, thanks for sharing.